right, folks, we'll come on back here to the Diagnostics Trading Hour right here on TFNN.com. And I'm your host, Daryl Martin, right here. We'll check out where the markets are right now at this one time. Don't forget, you can listen to us live inside the eSignal platform, also on your mobile phone at TFNN.mobi, and see live trader commentary all throughout the day at TFNN.com on Tiger TV. Let's check where the markets are right now. We got the S&P is currently down 7.5 points. We got the Russell down 10, almost 11 points on the day right now. Nasdaq's down 8, Dow down 65. So markets taking a bit of a hit. Looking on over at our metals market, we got copper right now just getting slammed down 2% on the day. Looking on over at gold, it's just down about $5. We got silver pretty flat on the day compared to yesterday's settlement. Hopping on into the energy sector. And let's see, we got natural gas is up 3%, a whopping 3% on the day. Massive move. And natural gas is a wild and crazy instrument. And just be aware that if you're trading that, got a lot of danger there. If you want to trade it with defined risk, then hop on over to Nadex and check out their contracts. If you don't know what they are, let's go on over here. Let's check it out. Let's go into TFNN. Okay. .com, and then click on the Nadex banner on the right side of the page. From there, go ahead and click on Trading, Demo Trading Account. Once you've clicked on a Demo Trading Account, go ahead and put in your username that you want. Put in your first name, your last name, your phone, and your email address, and click Apply for Demo. And then you will be able to hop on up here, click log in, and just check your email because you'll get the password there. And you'll probably want to change that password to one that you'll remember because you can even log in on your mobile phone, on an Android phone, Windows phone, and, of course, on an iPhone. They'll put $25,000 of funny money in there for you to play with. You can go ahead, you can go to your account section. You can update your password so it's one that you remember right over there on the left side. And then you can hop on in here and start placing some trades. Well, one of my favorite things to trade over on Nadex are the spreads. So you probably heard me talk about those once or twice before. And if you don't know what the spreads are, they're basically like an option for day traders. It's about the easiest way I can put it for you. Okay? And I mean, really, that's what it comes down to. It's very simple, and it's not really a complex thing to trade at all. And I thought what I might do is go in and talk about those today a little bit for some of you that maybe don't know what these spreads are and how they work, and how do you put all of that stuff together? How do you actually trade these Nadex spreads? Would you want to trade the Nadex spreads? And if you did, what are the advantages? What are the disadvantages? How do they compare to futures? How do they compare to options? How do they compare to stocks? What are all the different benefits of trading over on the Nadex platform? So I figured that's what we'll do today. We'll talk about Nadex spreads and go into them and teach you how they work. Okay? So with that being said, let me open something up, and I might be able just to start walking you through them. If this will work, I'm hoping this will work. I'll get back to my normal view, and let's put this up into a slideshow right up here at the beginning. Give me 1 second. I'll put that up and get rid of all this fun stuff. Okay. Now, so what is a Nadex spread? Let's talk about it. Well, first let me give you an example of how this starts off. And we'll do this in between commercial breaks and, put all the pieces together. But let's just say you're trading the pound dollar, and this is an older chart. It's just an example. Okay? But you go in, you're looking at this chart, and you're like, I think I'm going to draw a trend line right here. So you put a trend line on the chart. And by the way, you can do this on pound dollar, euro dollar, Aussie dollar, dollar yen, dollar franc. You can do it on all sorts of markets. You can do it on gold, copper, oil, natural gas, silver. You can do it on the S&P, Nasdaq, Russell, the Dow, the DAX, the FTSE, the SGX, Nikkei 225. So there's quite a few markets that you can trade on over on Nadex. But anyway, so you draw your trend line, and maybe you have a fib there, maybe you have a golden ratio, whatever it is that you decide to use. But you decide that the market's gonna bounce off this and move on down. You think it's gonna move back down at least to this low right here, 1.56. That seems like a reasonable goal, and you're trying to be a disciplined trader, but you hate putting those tight stops in because you hate getting stopped out. But if you don't have one, then it's gonna hurt you. And so you put a stop up here at the top, and pretty decent little distance away. But anyways, you put it up there. You do 100,000 units, a single lot, of pound dollar, and you end up putting it 56.85. Your stop's 57.50. Again, it's pretty far away. Probably not the most advisable, but you're just sick of getting stopped out. And so you have a risk of $650 on this trade. You get a margin of $3,000 you put up on the trade, and then what happens? Bam! It goes up and hits you. Right? You've had that happen maybe today, yesterday, this week, last week. Most likely. Right? We all have. And that's not the worst part. So the worst part is the journey. Right? The journey of the market. This tick, tick. I mean, this 2-hour journey, right? 2-3-hour journey all the way up here. And you're feeling every tick with every heartbeat. And as it moves up, you're going, no, go down, and you're tapping on the top of your monitor. You're trying to get the market to drop. You're rallying people in the chat rooms, and you're like, it's got to go down. And, you're analyzing 12 other charts and other instruments, and you're looking at the DX. You're looking at everything you can to try to justify why this thing is going to go back down. And then as it gets up to that closer, 5-10 minutes away, you're like, okay, maybe it's not going to go down. So what am I going to do? Am I going to go long when I get stopped out here? But, man, if I go long, it'll go back down. I just know it will, because that's a major resistance level right there. And but if I go short, wouldn't you know it, that's going to be the time it's going to take off. And if I sit on my hands, of course it's going to go back down right to where it should have. And you're faced with that. Day in and day out is psychologically detrimental to your trading. And especially for a day trader, because, you're trading faster, right? And so you really feel it a lot more than somebody who's been sitting on a position for a longer time. And you're in here, you're trying to decide what to do, and you make your decision. Whatever it is, it just seems to be wrong just about every time. And or at least every other time, right? The times that it really matters. And sort of laughing with that pain with you, And then what happens is the final worst part, the slap in the face. The market drops right back down to exactly where you said it was going to be. And you're like, I knew it. I knew it was going to go down there. I knew that was going to happen, okay? And, well, what if you could get rid of that? What if that could not happen to you any longer? As far as just a normal, pound dollar long short trade, it stops you out and goes back. I'm not saying that all your trades are going to be profitable, of course. That would be, impossible. But the point is to say, to not have to deal with that agony, that pain, to know what your risk is when you start out, and to be able to really enjoy trading, to be able to relax, to make trading, honestly, a little bit boring. Okay? And that's what trading Nadex Spreads is about. It is about making it a little bit boring, because it's about defining your risk, about letting your plan have time to work out, about being able to use higher leverage but with lower risk, and sometimes without a stop loss. Sometimes I use stops. Sometimes I'll get out. I don't have to risk the entire amount. But it's one of the many advantages. And a lot of times I'll go in, and we'll talk about this, here in the upcoming weeks. I'll go in and I'll hedge it. I'll flip this thing around. I'll buy spreads, and I'll sell the FX or the futures or whatever. But just as a spread by itself to make sure you get it. And so let me go past a few of these steps here and update this. Here, give me 1 second. Trying to bring this up. Give me 1 more minute. Okay. So as we're putting these steps together and trying to make this, work for us in our trading plan, we're trying to, go, okay, well, what is a better way that I can trade? Because I don't want to change my trading plan up. I've been, trading a certain way for a long time, and I like my technical analysis and this and that or whatever, and it's like, I'll change it if it'll work, but I don't just want to be, spinning my wheels on things. And, well, that's where the spreads come into place. They're going to help you maximize your leverage, minimize your risk, help you get stop losses for pennies on the dollar, okay? And there's a few things I've learned that you need to make money in trading. One, you need to reduce your risk. I think everybody can agree that the more you can reduce your risk, the better. Okay? The second thing you want to accomplish is you want to maximize your leverage. Usually those two things don't go in the same steps, right? Because increased leverage and comes with increased risk because the sword cuts both ways, right? Well, not on Nadex Spreads. Think about like a call option. If you buy a call, right? I mean, you're getting like, a 10 to 1 or whatever with it. I know people say 100 to 1, but it's really like 10 to 1. And, well, it only cuts one way because it goes against you, the pain stops. But you don't have to be out of the trade. Sort of the same thing with a spread. But think about spreads as options for day traders. Okay? So reduced risk, increased leverage, and then you need time to be right. Because like on that trade back there, you were right, but you were right a little bit too soon. You needed more time. Okay? And so by not having to have that stop loss, it can give you time to be right. But also, more time to be right is you need to make sure you choose the right spread. That's where the expected ranges come into place that I talk about, the deviation levels. What's a realistic expected move? Different things like that you really want to make sure you're on top of when you're doing these trades. So, this is new to a lot of you. So as you're sitting back, as you're enjoying the show, as you're learning everything, I'm going to break it all down for you step by step and go into it. So right here, what is it? It's a contract. You buy it if you think the market's going to go up. You sell it if you think the market's going to go down. And if you're not an option trader, good news, you don't have to worry about all the complexities of Greeks, like call and put options. So, wow. Okay, so that means I don't have to worry. You don't have to get all heavy into delta, gamma, theta, vega, rho, all that stuff. I mean, it's not that they're not there. It's just that they're highly minimized to a point where if you just understand how a spread works and the basic concepts and a couple other things that I'm teaching all the time here on the show, that you're all set. You don't have to map all the Greeks out like you need to know your Greeks when you trade most option strategies, okay? But with these, why? Well, because the expiration time is so small, a day or less, that the Greeks are highly minimized. And I'm going to talk about that when we get back, so stay right there. All right, folks, we'll come back here to the Diagnostic Trading Hour. And I want to say thank you real quick to everybody. I know a bunch of y'all out there had given. My daughter is raising money for her school, doing this big contribution thing where she runs a bunch of laps. People pledge dollars. And want to say thank you to all the guys out there that contributed and all the ladies as well. And on her little website she put up, and she made this cute little video. I know it's a tangent, but felicitymartin.com. And she's passed her goal, which is awesome. I'm so proud of her. But she made this whole little video and basically trying to raise money for computers for the school. So, and she runs laps and this whole health kick and character thing and all that. So it's pretty cool. I'm excited. I'm really proud of her. But thank you to everybody who has helped support her. Again, that's felicitymartin.com. She's doing a really good job. All right, proud daddy. Back on topic, talking about spreads. Okay, so what is a spread? Basically, if you think the market can go up, you buy. Things can go down, you sell. We talked about it. Doesn't have the complexities like Greeks. Or all the complexities of the Greeks, like normal call and put options, mainly because they expire within a day or less, sometimes within 30 minutes or an hour, 2 hours, 22 hours, okay? They're all 1 day or less. They open as early as 6 o'clock at night, okay? And they trade as late as 4:15. Just depends upon the market that you're trading. And so when it's that close, you don't have a massive amount of time decay, which is theta. I mean, whatever premium you got, that's your theta, because you have 1 day of time decay. You don't have to calculate it out. It's whatever is there is the theta. And you don't have to know what it is, just know what the premium is. It's like, okay, well, if it's, a point off of the market's quoting at 1705, and to buy the spreads at 1706, well, then there's 1 point of theta, okay? 1 point of time decay in there, 1 point of premium. What about, things like, rho? Well, rho, I mean, come on, there's no interest right now, so that doesn't really matter, regardless. We go on over, we look at, what about Vega, implied volatility? Well, Vega actually impacts, say, an option more the further it is from expiration, because there's more time. If you just go look at Vega, Vega gets larger. Of course, IV is smaller, but Vega is larger the further out from expiration. Now, the IV may have different fluctuations based upon current market events, news coming out, things like that. That could jack up the IV, but sometimes does. That's actually how we take advantage of it on news trades. But you don't have to know the IV. You just look at the thing and you're like, is that thing just ridiculously priced? And if it is, great. Take the opposite side of it and collect that premium. If not, just trade it directionally, just like you're trading any other trade. Okay? And, maybe some of y'all out there are used to, things like credit spreads, iron condors, okay, iron butterflies, broken wing butterflies, iron cockroaches. I mean, we just go down the list, right? Well, you can go on there, you can do these, but imagine not having to wait like 4 weeks or 1 week to have the trade expire or that time to decay to get that maximum time decay. Imagine being able to get that over the next few hours in the current day, being able to repeat it multiple times a day or at least multiple times a week. Well, you can do that. Okay? What about delta and gamma? Okay? Well, delta, if you don't know what delta is, if you have a delta of 1 or 100 there, it moves basically dollar for dollar the same speed as the underlying market. So if Apple moves up $1 and you have a delta of 1, then your option would change and would increase by the value of $1. Okay? If Apple moved down $1, then your option would decrease in value by $1. If you had a delta of, 0.5, then your, option would move up. If the market moved up $1, you'd make 50 cents. If it moved down, you'd lose 50 cents. Okay? So, because it's moving at a delta, a rate of change. The price changes that percent based on a $1 move in the underlying market. So, again, if it moves $1 and you have a delta of 0.5 or 50%, then it'll change 50 cents because that's 50% of $1. Okay? A delta is just for $1. Gamma is the delta of your delta. So if it moves from 1405 to 1406, and let's say you had a delta of 0.7, okay? So your option went up by 70 cents. But let's say you had a gamma of 10. So when the market moved $1, your option went up by 70 cents because your delta was 0.7, but then you had a gamma of 0.1 there. Therefore, now your delta is going to be 0.8 or 80 cents for the next $1 move. That's how gamma works. Well, the thing is, delta at expiration has to be 100 or 0. Okay? It's either going to be in the money or it's going to be out of the money. It has to be, moving as fast as the market or not at all. And because there can't be any premium left inside this option at expiration. It's not like a binary. It's not an all or nothing. It's just the delta itself, the speed of movement has to be 100 to 0. What does that mean? Well, the closer you get to expiration, the bigger that gamma gets, which pushes that delta closer or further away from 100 and therefore makes it move faster. So when you got expirations that are closer in time, the option will move faster once it's in the money. All right, we'll go more into them and break them down step by step when we get back right after this break. All right, folks, we've gone back here to the Diagnostic Trading Hour. And I want to make sure that, for you option traders out there, you knew that they were very similar. The spreads are very similar. That's what we're going into. We're in the Diagnostic Trading Hour today. We're talking about Nadex Spreads, how they work, and how you can take advantage of them. Okay? All right, so with that in mind, let's go ahead and move on to the next step here. Nadex calls them bull spreads. I call them box spreads. If you draw them on a chart, they're going to look like a box. Pretty simple, right? If you buy them, they're bullish. If you sell them, they're bearish. Hence why I don't call them, bull spreads. Because they're not just bullish. And I've asked them to change the name. I think they will eventually. So we'll see. But, everybody likes the bull market, I guess. But, as a trader, I love a bear market because it moves fast. So you may have heard the saying before, the bull goes up the stairs, but the bear goes out the window. So I like that speed in the markets. Anyways, so just to clarify that whole bull-bear issue on there, to give you a little comparison on margin, when you use margin on a security, you're borrowing money from the broker. Therefore, you may be paying interest if you're a net negative cash. Okay, so that's one of the downsides of margin on a stock broker. Cash, if you're using cash margin on stocks, it means you have no leverage. If the stock costs $100, you put up $100 to buy it. Okay? Most traders, whether they know it or not, have Reg T margin. That means 2 times the leverage. 50% of the leverage risk is equal to the value of the underlying. So most people have this kind of, when they trade stocks and ETFs. So if a stock costs $100, you put up $50 to place the trade. Okay? So, but your risk is still, $100 on the trade. It could, theoretically, and sometimes does, gone down to 0. You may get day trading margin. Could be 4 times the amount. Could be even higher. It depends really upon the broker that you're at, the rules that they give. Maybe you get portfolio margining. But about as good as it gets is, either the maximum risk, like on portfolio margining, or if you're going in and you're looking at, let's see here. If I'm just trying to think of some good examples, but if you bought a call for $2 and bought a stock for $100 or put, or if you bought a stock for $100 and you bought a put for $2 on a $100 strike, then they don't make it up $2 because it's either maximum risk or 15% of an expected move, unless it's like a double leveraged ETF or something like that. But that's just to give you some ideas. There's different ways to trade. There's different instruments that you can use when you do it, and I'm just wanting to help you understand some of those ways that you can maximize your trades. But this is how leverage works on stocks. So what other you got futures margin. That's really fun. All types have uncapped risk except for down to 0. I mean, if you're trading, the S&P, and let's just say the S&P, let's see, what is it at right now? Let me pull it up to give you a current quote. We got the S&P at 1994. Let's make it easy. Let's just say 2,000, okay? It's worth $50 a point. So if it's 2,000 points right now, if it's worth $50, that'd be $100,000. So if you shorted the S&P, we have unlimited risk up potentially. I mean, theoretically, if you went long the S&P, it could theoretically go to 0. It's not going to, or not planned to. However, still, that is the maximum risk. But here, to get a realistic point of view, what if the S&P dropped by 1%? That could be a $1,000 loss. Okay. A 2% move, which would be a massive move in a day, but it has happened in the last 12 months. That'd be a $2,000 loss on one contract. In addition, with futures margin, you got to deal with things like initial margin. Okay, that's the amount of money you got to put up to place a trade. You got maintenance margin. That's to keep the trade open overnight. You got maintenance margin. We talked about that. We got day trading margin. That'll be usually between 10 and 25% of the initial margin. So brokers will give you a break, like maybe $400 to put up for the S&P. Okay, it's about $4,000 in initial margin right now. Or some brokers have day trading cash market hours where they won't give you the 10%, they'll only give you the 25%, and they'll only give you that like in between cash hours, like 9:30 to 4:15 or 4 o'clock or whatever. They won't give it like overnight trading, pre-market hours. They're making you put up full initial and maintenance margin. Okay, so it's really fun and complex to learn all those details. What about leverage? Well, leverage varies by broker. Okay, so it's depending upon what broker you're using. And so if I'm looking at, different brokers here and trying to figure out what I'm going to do on that. Give me 1 second. I got to click a button over here. Okay. Usually, if you're outside the U.S., you get it up to 400 to 1. If you're inside the U.S., okay, then you're looking at about a 50 to 1 on whenever you're putting up the leverage. So that means a 50 to 1 inside the U.S., you're putting up, $10,000, about $200 in margin. That'd be 50 to 1. To control 10 grand, you only got to put up $200. And all this does come back to spreads and how they work. So right here, so if you go in there and you put that up, you put up $200, not too bad. Well, margin and leverage can vary on options. It depends upon what strategy you use. So, if you're, short a naked option or this or that or whatever, it can really, it can affect, obviously, your account and the different margins. But I want to give you a comparison because that's what it really all comes down to. Let me see it side by side. If I looked at the FXC, the Euro-Dollar ETF, and basically what I'm doing here is I'm sort of trying to equalize this thing out across the board, make everything worth $125,000. And so I had to do 12.5 spreads because you don't have a half spread. I didn't want to go up all the way up to $250,000 in size. So this is the minimum size I could do of a single thing of like a single future contract, and then equalizing everything else. That's how I put it all together. Okay. So with that in mind, what does that bring us to? Well, if I did 1,000 shares on the FXE, then the leverage value would be about 125 grand. If I had day trading margins, if I had like 4 times or whatever, then I'd put up like $31,000 to do the trade. Okay? And if the market, moved up, and I went long on it, if it moved up, and, X number of ticks, I'd make $3,000. Moved down X number of ticks, with bid-ask spread, all that fun stuff, I'd lose $3,100. What about if I went on Spot FX? Spot FX, if I did the same thing. Okay, I do 125,000. So I'm basically doing like 12 full lots and, like 5, I guess what I don't know, whatever they come out to. But basically I'm doing 125,000 units of currency on the euro dollar. And day trading margin 50 to 1 would be $3,100. So a lot better margin on the Spot FX than on trading the stocks. And 50 to 1, so I go in and I put up $3,000 to do the trade. No, I'm sorry, I make $3,000 on the trade. If it moves up X number of ticks, and I lose $3,100 if it moves down that same number of ticks. So, okay, well that's good. So I can actually get more leverage. Remember I said at the beginning of the show, you need more leverage. You need less risk. You need more time to be right. Well, we got the more leverage. We got the same risk. Really no other benefit on time to be right, just because, if it hits the price, you're stopped out either way. What about futures? Do I get even better leverage there? Yeah, I can put up $500 on 6E. I can control 125,000 units of currency there. That's a 250 to 1 leverage. And so now I got even more leverage. Doesn't mean I have to risk more money. I could still just lose 3,100 if it moves down X number of ticks. I can make $3,000 if it moves up X number of ticks. Okay. Well, what if I move that on over to the options? Well, so I got the great leverage, but I need to get that risk lower. Well, I go to the options, and I do get my risk lower. I get it down to 1,250 if it moves down the same amount of ticks, but I only make 463 if it moves up because the delta and gamma aren't going, very fast. And I lowered my risk, which is good. My max risk on the trade is 25.37. I'd only lose 1,250, like I said, if it moved that same number of ticks as we did on the other examples. But my leverage went down to 50 to 1. Really not near as good as I was hoping it would be. Well, then I look over at the Nadex Spreads. And if I do 125,000 units of currency on the Nadex Spreads, it's equal to 12.5, give or take one spread, okay? I put up $250 on the trade. Well, my margin and my risk are the same. That means that is my maximum risk. So if it moved all the way down X number of ticks, the most I'd lose on the trade, $250. Wow. Well, I definitely got less risk. What about leverage? I only put up $250 to control the same amount of money. I got 500 to 1. Wow, that's over 100 times better than stock. It's 10 times better than, options or Spot FX. It's twice as good as futures, 500 to 1. If it moves down, I only lose $250. That's like 10% of the risk on stock, on Spot Forex, and on futures. And it's about, 20%? 25% of that on the future options, so even less risk there. And I make $28.75. I make like $125 less, but I cut my risk down by thousands of dollars. So definitely worth it. So I got more leverage, 500 to 1. I have less risk, 250, and I don't have to use the stop loss. I got more time to be right because it's an option. Okay, so that just is a nice little comparison for you, comparing stocks, options, and Spot FX and futures FX with Nadex Spreads, and sort of putting those different pieces together. Okay. Now, what about some of you option traders like, yeah, but I don't quite know about how they price these things. Okay. How do they put these things together? Well, let's compare them to the S&P 500. Okay, E-mini options. And let's see how they compare. Well, S&P E-mini option, you're basically buying 50 options on one contract, and that equals $50 a point in full delta value. Over on the spreads, you gotta do 5 of them because they're $1 a tick. They tick in 0.1. That's $10 a point, 10 dimes a dollar, right? You gotta do 5 of them to make it worth $50 a point. So on this one, what I do is I go down Friday and I can compare them because S&P E-mini options expiring on Friday. Nadex Spreads expiring on Friday. They have the exact same expiration time on the exact same underlying market. So everything lines up. And so I looked at a buy, so that means I need my floor to be the same as the call strike, 1655 versus 1655. Okay, and they match up. Let's see, well, on, looking at this right here with commissions built in, $266 to do the exact same trade on an S&P mini option, $270. So we're talking, a few dollars difference to do the trade over on Nadex, a few dollars more in this case. But right there, right lined up. Let's go look at another example. What if I, sold a spread, or I bought a 1655 put? In this case, we got $61 to do the trade, $60 to do the trade. So better there on Nadex. Okay. Let's look at another example. I'm going to sell 1670 over here. Sell 1670 ceiling there. And risk on the trade is $566. Risk over here is $550, a little bit less. So, it's a little bit less, a little bit more goes back. $16 less currently on this one trade on Nadex. And so that just gives you an I just want you to see the pricing is the same. It's using a Black-Scholes model. And basically it's going to be the same as a call from the ceiling up to the middle. It'll be the same as a put from the floor up to the middle for a call. And then it'll be the same Black-Scholes as the ceiling down to the middle as a put. Okay, so it's just a simple Black-Scholes model. So all the products on Nadex have capped risk. You can't lose more than you put up in margin. Your risk is your margin. You still get the leverage. You can trade stock indices, you can trade future commodities, and you can trade Forex pairs. Price is driven by the underlying market. It's not driven by supply and demand of the spread option. The market maker is making a market based on where the underlying market is located. You can't have $10 as intrinsic value and only charge $5 for the thing, or else, well, I wish he would, that I would take him for all he's worth, but they're not going to do that. It's a simple Black-Scholes model. So the market goes up, the spread goes up. The market goes down, the spread goes down. As long as it's, in the money, the price is in between that floor and ceiling. Okay? It'll move in pips or ticks. If you trade stocks, you're used to the term cents. That's the minimum increment move of a stock. Okay? Well, a future has a tick because some things tick in dimes and nickels and quarters and eighths of cents. And they all have different values. It makes it really complex. Forex has pips because you have different currency values. Then things are quoted in yen, some things quoted in pounds, some things quoted in dollars, some things in francs. Makes it fun and complex to backward, figure it all out in dollars. The beautiful thing about spreads, everything moves in a digit of 1. Whether it be 1 or 0.1 or 0.01 or 0.01 or 0.001, they all move in ones. And every time it's worth $1. It doesn't matter what instrument it is. So it makes it really, really simple. Okay, so we got a ceiling, we got a floor on a spread. As an example, let's say you have 2,400 and 2,500 as your ceiling and floor on euro-dollar. Okay? And what is the difference between 2,400 and 2,500? 100. 100 pips. That's where the term spread comes from. It's the difference between the floor and the ceiling. Okay? Spread. We'll talk about what this means when you buy and sell a spread when we get back after this break. All right, folks, going back here to the Diagnostic Trading Hour. All right, so we got a floor, we got a ceiling. Okay, the difference between that is 100. And remember, every pip tick, whatever you want to call it, is worth $1. So that's a $100 value on a floor ceiling. So the spread again is the difference between the floor and the ceiling. And we go in here, we got 100 pips. And the last digit is how it ticks, how it moves. Every tick's worth $1, $100 value, it's a $100 spread. Now, if we go short of spread, okay, we can't lose any additional money above the ceiling, and we can't get stopped out. We also can't make any additional money below the floor, but I don't think too many of us are having problems of taking 100 pip trades over and over and over again throughout the day, intraday, okay? So really, don't give me it's capped. Well, if you want to uncap it, then use a hedge strategy, okay? But unless 100 pips are a consistent problem that you are having of taking large 100 pip profits on a consistent basis intraday, then I think you'll be okay. So if I sell it at $24.90 and my ceiling is at $2,500, the difference is 10. 10 pips, that's my risk, that's my margin. I have $10 of risk on the trade. If I sold it at $24.90, the most I could make would be down to the floor $2,400. 90 pips, $90. Now again, you could do 10, you could do 100 of these contracts. I'm just talking about one, okay? Just to make it easy. So $10 of risk. That's to control $12,500. That's a that's over 1,000 to 1 margin. Okay? So massive leverage defined risk. Okay, time to be right. You got till the end of the day. You know, you can choose whatever you want. You can choose one at 10 minutes. You can choose one at 3 o'clock. You can, you know, whatever. So there's different spreads that you can, you know, take advantage of. Except if it moves down, you can make as much as 90. Now, what about if you go long? Well, you can't make any additional above the ceiling. You can't lose any additional below the floor. So if you buy it at 24.10, your risk is capped at 2,400. You could go down as low as it wanted to. You'd still be in the trade. You'd be down, but not out. You'd be down $10 at most. Okay? If it moves up, doesn't matter how high it goes, the most you're going to make on the trade is going to be $90 on a single contract. Now, again, you could do 100 contracts. Okay? Well, that'd be $9,000. Okay? Now, you can get in, you can get out whenever you want to before expiration. So you can sell, buy, sell, buy, sell, just like you do on Eurodollar. Okay? If the spread expires, it'll close at the settlement price at the time of expiration. Okay? So again, if the spread expires, it will close at the settlement price at the time of expiration. The settlement price is based on the underlying market. They're basically going to look at the last 25 trades right before that contract expires. They're going to average the middle 15, and that's going to be your settlement price. On Forex, they're going to take the last 25 mid prices and the average of the middle 15, and that'll be your settlement price. Okay? So pretty simple. You can, and you don't have to do anything, by the way. There's not like you don't have to exercise, you don't have to submit something. There's not an additional fee. If it expires in the money, it's the same as closing the trade. By the way, what is the commissions? It's 90 cents a contract. You're not a commission because there's no broker. You're just direct with the exchange. You're not trading. The exchange is not trading against you. They're just an exchange. They're meaning traders to traders, market makers to traders, etc. So you have transparency in pricing, but anonymity of who's on the other side of the trade. Okay? You and whoever is on the other side. So 90 cents contract in, 90 cents contract out, 90 cents contract settle. If it expires out of the money, there's no fee. And it caps at $9. So if you do one contract, 90 cents, 5 contracts, $4.50, 10 contracts, $9, 100 contracts, $9. That basically is how it works. Intraday is as little as 2 hours. They can go up to 22 hours and 15 minutes. And you got spreads. You have like a 2-hour one. It'll be only like say 100 pips wide. Okay, you got one that's going to expire that has say 8 hours. It'll be like 250 pips wide. So it's wider. They have 250 above, 250 below, and then 125 above, 125 below for 250 straddling it. And then you got a big master spread that's like 600 pips wide. All this means is they set them automatically with the exact same criteria right before the spread or the option starts trading. And I already went over the markets with you. So that's a quick, very quick rundown on Nadex Spreads and how they work. And we'll talk about it more tomorrow. You have a great day.